global economy faces extreme challenges of inflation. Central banks have held the rates so low for so long that liquidity was abundant, and now they're withdrawing this liquidity. So as a result, the opportunity set for investors for the next 2 to 3 years or 3 to 5 years will be different. It's going to be all about financial liquidity, and possibly for me, the scarce of liquidity that will be actually an opportunity for those that actually have cash in hand. That's typically insurance companies, banks usually, but not this cycle. Regional banks anyway, right? The larger banks have cash, but the regional banks are strapped for different reasons, right? However, the drawback in liquidity from the regional banking crisis in the US was met with an extraordinary injection of liquidity from Federal Reserve. I think that surprised some of us, including me, that are critical towards Powell. I'm one of those people. Usually when a crisis occurs, central bank obviously steps in to provide support, but usually you want to punish those irresponsible behavior. And there was not a single so-called irresponsible player that were hurt. There was a massive abundant liquidity provided. And so we actually had from March to July, an incredible liquidity that was flushed. And so here we are again, withdrawing liquidity. We know interest rates came down quite a bit. The Fed's going to stay on hold. A lot of positive feeling for equities. But actually, last week was kind of a meaningful deterioration where manufacturing PMI came down, stayed down meaningfully. ISM service sector PMI came down, and unemployment started to drop. It's 150,000, but unemployment tends to be lagging indicator. And then on the positive side, you have very resilient corporate America. Why is this economy more resilient for corporate America? U.S. corporations have done well, right? During pandemic, they issued bonds at a very low interest rate. In fact, some of these companies have a large cash balance earning a nice positive spread from when they issued these bonds during COVID, and yields are higher. They actually have reduced average work week of employees. The employees have higher wages, so there has been a positive balance that kept this economy going longer. But it's starting to show some weakness or employment rate. So here we are. Accelerating recession timeline for me is firstly, you have Federal Reserve obviously tightening. This is one of the most significant tightening over a very short period. And I'm sure many of you are aware, these things take 12 to 18 month lag, and we are starting to hit that, what we call red zone of the tightening actually starting to bite the economy. And then next comes the lending conditions. And I'm sure you've been reading that the banks in the US, especially regional banks, have been tightening and lending with a much more strict lending standards. And this has been continuing. I think it's getting close to as tight as it will be, but as we proceed, perhaps it's probably reached its peak of how tight it will be. But bank lending standard has been quite restrictive and is starting to bite. And because of the banking crisis in the US, Federal Reserve stepped in and provided liquidity. We've been given a little bit of a brief pause, but I think we are, again, going to find ourselves in a pretty tight lending moment for the rest of next year. So as the lagged impact of monetary and banking conditions have taken its toll, and as inflation has reaffirmed in the US, market financial conditions are finally starting to react. In our view, this is an early sign that another market liquidity event may be coming in the new year. And so we will presume liquidity will be equal to more important in 2024, right? So this may sound all concerning. Recession is likely on its way in US and Europe and perhaps many parts, including here. Liquidity will be challenged as market conditions begin to react to that economic reality. So as a result, dislocation appears likely. So that's all kind of fear and gloom. However, there's going to be opportunity. basically, I think next 2 to 3 years is going to be an interesting opportunity thing. And not everyone even is forecasting a recession, but everybody is forecasting some sort of a slowdown where liquidity will probably play a factor in certain segments of the market, such as real estate. I think that's one of the areas you guys are here to talk about. So in this regard, actually, this whole thing can be flipped on its head and say, despite recession forecast, there is actually a liquidity-driven opportunity that can come to place where with yields so high, and it's actually now a great time to be a bond investor or a lender. We can see that, particularly in US anyway, and for that matter, UK and Europe, but I'll speak using US as an example. When was the last time, I can't remember since the world of QE, where you can actually get a coupon yield of 10% in real estate, even after paying a heavy management fee, you're still walking away with 9%. Or if you're looking at direct lending, we're middle market players, so we get a little extra coupon. We can collect 12% from credit risk. So you're looking at unlevered 9 to 12% yield. And then you can add to it some liquidity crisis, mild recession, and then you're looking at 15% return unlevered without taking what I would call a significant risk. So that's, I think, what gets me very excited, that you can get equity-like return for a much safer, and I would say always for the next year or two, stay senior, meaning don't get into mezzanine. I don't think I need to caution that to some of the office mezzanine investors in Korea, but you have to stay, I think, senior for next year or two. At some point, I suppose you can go down the risk spectrum in private debt, okay? My expectation of equities is not very positive or not very confident in the next year or so. In this regard, I say, you can stay safely in fixed income. And like I said, if you get into alternatives, the numbers go up, right? You're getting paid for liquidity, so-called premium, and you're going to get abundant of that liquidity premium.